Okay, guys, you made it. One last amazing panel. Maybe Francis will wake us up a little bit.
I will. All right, he was wrong. I'm standing between you and drinks, or we are. We do have panelists on this panel, right? Look, half of you are standing already. Why don't the rest of you stand up as well? Everybody stand up. Do whatever you need to stretch, because we got one more hour.
No, I think it's the.
All right, now sit down. First of all, I have an admission for those of you in the room. I am not Zach Rosenberg. There are times, though, I wish I was. I don't know how many of you have had the chance to work with Zach. I probably met Zach in 2006 or 7, not long after Katrina. And, you know, the commitment that he and his wife have made to commit their lives to the lives of others is something that I've learned a lot from. You know, being an insurance exec for 30 plus years, you know, I was in a lot of rooms with a lot of claimants who really took in the value of insurance. But it wasn't until I started getting involved in SBP and started to work with parts of that population that don't have the benefit of insurance that I really get a better understanding of the big picture when it comes to disaster resilience and recovery. So if you're not already involved in a nonprofit that's helping that part of the community live through these terrible incidents, I would strongly encourage you to do so. It is such a valuable, not just a personally enriching experience, but a professionally, it opens your eyes to the system, the entire system in which the insurance industry operates. And I think the issues we're talking about, I think every panel has touched on the systemic nature of the solutions. And I think getting involved in a group like SBP has allowed me to really see the system in a much more holistic, equitable way. And I'd encourage you all to do the same thing if you have the opportunity. But that's not what this panel's about. This panel's about the one piece that we absolutely, positively, definitively know works, and that's Build Back Better. It's the cheapest, it's the easiest time to do this. This is when the roof is just waiting to be rebuilt and has just had a wind go through it that could have been withstood with the right straps or whatnot. SBP is, with the help of Travelers and others, have been rebuilding to fortified roof standards, and it's remarkable success. And we have 3 folks up here who are warriors in the same battle. Now, I know one thing Zach did want to talk about was the success they had and that SBP had in New Orleans, building an apartment building called the St. Peter. How many units are there? 50 units. Thank you. You both had the same answer. Good. 50% of them are vets, older, retired vets. And this building is completely net zero. They have 0 utility bills. So think about retired military folks having 0 utility bills. Not only that, when the lights go out in town in New Orleans, and they go out a lot in New Orleans, they don't go out at St. Peter. This is a self-sufficient, kind of off the grid. They're solar powered. They stay warm in the winter if the electricity goes down, and they stay cool in the summer when the electricity goes down. And that's a Build Back Better example because they knew what to do, they knew who they were building for, and they did it. Now, our panelists here have done the same thing. I don't know the panelists, so I'm going to ask you to introduce yourselves. Zach may have he didn't give me the intro, so it's all Zach's fault. But maybe we'll start with Don. Don, you're with UNC, I understand?
So, right, they have me listed as a professor at University of North Carolina, which is true. I also teach at Duke, but I'm not here in that capacity at all. I'm here as an insurer on the board of directors of the North Carolina Insurance Underwriting Association.
Oh, great. So not NC State. You're still just missing one in the triangle, huh?
We work with NC State.
All right, okay. So who do you root for in basketball games?
I hate Duke.
Now, tell us what you really feel. I mean, wow. Okay. You sound like a Syracuse person, which I am, by the way. Eric, the industry guy, or I guess not the only industry guy on the panel.
One of the few
but-
loss control guys in the room, I think.
All right.
You know, I've been with Chubb.
Wait, there was a clap there, Eric.
Thank you.
Oh,
Yeah.
Never
you're
mind,
gonna
it was just Charlie.
You're going to get some engineering perspective. I have 25 years with Chubb. We call it risk engineering today. Some of our competitors call it resilience today. We used to call ourselves loss control. So I've inspected thousands of buildings. I was an inspector for 20 years in New York and New Jersey, the 5 boroughs, before and after Sandy. All right, so I really look forward to diving in here.
And the Chubb Foundation put me through college, so if you want an extra question or two, Eric, just let me know.
Sounds good.
And Rob, NRDC, tell us a little bit about yourself.
Yeah, I'm Rob Moore. I work at the Natural Resources Defense Council. I'm a senior policy analyst on our climate adaptation team and lead a lot of our work around flooding and sea level rise. So we do a lot of work around advocating for reforms to the National Flood Insurance Program. Been working a great deal on reforming state real property disclosure laws around the country, and then quite a bit of work around buyouts, which I'm going to talk a bit about today.
Great. Buyouts. Those are the complex ones, right? So we're going to save that for the end.
You say so.
Yes, I say so. All right, we're going to start with Don. Don, you've done some research. My understanding is you've done some research on Build Back Better and the buyouts and whatnot, and you can empirically prove that it works. Is this right?
So wrong in almost all regards, but let me
Yeah, I'm
just
just
fill in
reading the notes,
What I
so-
do. It has nothing to do with research. It has nothing to do with buyouts. North Carolina had its voice exit moment about 15 years ago. That's when insurers get tired of complaining about not having enough rate, and they just leave. They leave the state. So Farmers Insurance left North Carolina 15 years ago because it was too much on the hook under our then system for what it viewed as unlimited liability. So the General Assembly went into panic mode. I was an academic and was put on a commission to redesign our insurer of last resort to address the problem. So we did that. The General Assembly adopted it, and then no good deed. I got appointed to the board of this entity I designed as the designated fall guy. So if it didn't work, they would know who was responsible. That said, so for 15 years, I've been a member of the board of directors of the NCIUA, which is the insurer of last resort. Altogether with its sister organization, we insure about $150 billion worth of property, over 500,000 properties. We're absolutely the largest insurer at the North Carolina coast. On the Outer Banks, which is especially risky, we may insure at any given point 70 to 80% of every building that's there, because insurers refuse at the rate they're allowed to charge to do so. One of the things I take credit for is that at the General Assembly, I inserted into the bill the idea that this new entity would be invested in mitigation and not just coverage. So if the takeaway from this group is just that mitigation is an idea whose time has come, it was true 15 years ago. Even someone like me knew that that was the future. The claim to fame that we have is that we have implemented it. So for the last 8 years, we have spent, just as a company, justified purely on cost-benefit return basis, somewhere between $80 and $100 million to build roofs ahead of time that are more resilient. We did this by having Guy Carpenter, who is our broker, Guy Carpenter Analytics.
Excellent company, by the way.
Excellent company. Model for us what the payback would be, hypothetically, on a $50 million investment by us in these IBHS super roofs. And it turns out that in just a 10-year period of time, if there was just a 1 in 10-year storm, which I don't even view as a risk, I view as a certainty, we would get back $68 million for our $50 million investment. So on the strength of that, we actually started appropriating money to have people put on these roofs on our dime. We gave them a $6,000 grant because that is the price point at which it was cost justified to us. So it wasn't charity, We were actually at that price point making money over a 10-year period. Recently, with the hardened reinsurance market and the price of reinsurance going up, this last year, the board increased that from $6,000 grants to $8,000 grants, which we announced and implemented 2 weeks ago. We also increased this year's amount from $20 million, from $15 million to $20 million. Altogether, as I said, we have actually invested with our own money at this point, something on the order of $60 million. We additionally appropriated 2 years ago $10 million and challenged the North Carolina legislature to match it, with the idea that we were creating a positive externality, a benefit for the coast that transcended just our policyholders. And if they wanted to match it to get the public good, they could. They did. They gave us $7 million, so we launched a supplemental $14 million. We doubled down and currently have a $20 million new challenge grant in front of the General Assembly, which is in the final throes of deciding its budget now. And we have hopes that they could give us as much as 20, which would give us a $40 million addition, put us over $100 million overall. Let me just repeat, this is not just sustainable as a business model. We make money from this. And to the extent the reinsurance market stays as hard as it is, my view is that's just great. I would much rather give money to roofers to put on these super roofs in North Carolina and let that money circulate than the lovely people we meet in London and Paris and everybody else that has a probability of non-exceedance of point nothing. So they're just going to keep our money and we'll never get it back. Or we could actually get a hard return. Not that I don't love our reinsurance partners. That's our
I can
program.
feel the love, Don. I can feel it. Let me ask, Don, stick with you. The investments in the roofs, completely understood. Have you invested as well in, say, wetland restorations or other nature-based solutions which would similarly reduce the risk for the homes you insure?
Not our problem and not our risk, no.
No, not your problem, not your risk.
No, we
Explain
do
that.
not insure at flood as almost no private company does.
Storm surge, you don't insure?
We don't. If it's wet, we're not there. Excuse me. If it's wet from the top down, we're there with you. And just for the record, we're just a fantastic company. So I'd be remiss. Gina has been signaled out several times. By far the best thing I have ever done on the board is hire Gina Hardy to be our CEO, who's just one of the most well-recognized executives in all of insurance. And she runs, I mean, for example, in Florence, whatever you hear about insurers being late to cover people as an underwriting matter, we paid over 90% of our claims within 6 weeks. 0 lawsuits against us in our history. We are just an excellent nonprofit.
Love the passion. Thank you, Don. Eric, you've been out, what'd you say, 1,000
Yeah.
factories,
Yeah.
institutions, buildings, whatnot. Talk to us about the customer side of thing and how does that conversation go? You've been going to this facility for 10 years. Now you show up and start saying climate or new risks, higher risks. How do you actually get them to understand and internalize the complexity, but also the urgency around some of these new exposures?
So you opened up the conference using the word catalyst, the insurance responsibility, frankly, to be the catalyst for the conversation. Chubb has been very proactive in educating and providing advice to our policyholders. We've heard so many of these discussed, but briefly, agency education is a huge piece of it. Day-to-day risk engineering and loss control is a huge piece of it. We spend a lot of resources with hundreds of engineers at our top TIV locations globally. There's a lot of on-the-ground resilience, meaningful, actionable activity taking place. There's a lot of white papers, right? There's a lot of thought leadership that we distribute to our policyholders. There's a lot of benchmarking and risk management assessment tools. As you commercially scale the resilience conversation around environmental planning and policy, it quickly becomes, as this room appreciates, an extremely complex endeavor. We try to simplify the conversation to risk management basics. We like to visualize the data and show our clients portfolio level spread of risk. We externalize a lot of our internal aggregate data on accumulation and secondary perils. We're focusing a lot of conversation in this room on flood and wildfire. Well, I mean, look at some of the recent statistics on severe convective storm, on hail, right, on wind, obviously U.S. Atlantic hurricane. There are many other secondary perils driving climate change loss. There's a lot of climate risk that's non-modeled, all right? So we're doing a lot more property resilience assessment, I'll call it, right? We're very familiar with TCFD frameworks. Francis, you mentioned TCFD reports right up front at the beginning of the conference too. We're working with clients more than ever before on, how to make the task force for climate-related financial disclosure meaningful and actionable by keeping it simple, stupid, and starting somewhere. We get a lot of pushback on, paralysis by overanalysis, right? If I can't quantify the scenario, I'm going to have to wait till next year until the data is better. And by that logic, you'll never start, right? So it's giving customers a starting place, giving them the data, the best data we have available, to give them our advice on the starting place, by which locations. And it's helping them understand the large business impact, not just the business interruption impact, but the business impact. And we've talked about community level, utility level, access, you name it, a much broader level of geographical impact that these events can impart on a business, on a day-to-day business. And it gets the CFO's attention when we obviously show the quantified risk and we give them our best PML or our best AAL and really give them ways to provide effective business continuity planning. Resilience is business continuity planning on steroids for the commercial buyer. That's what it is. And there's nothing new about business continuity planning. But when you layer emission scenarios on top of that, right, it's a much different conversation. So there's a lot of translation. There's a lot of translation that we're doing today between this data and the day-to-day buyer of a commercial policy where, they're looking for, tell me what to do and where to start. Because that's where it is. Where would you start across your portfolio? What would you prioritize? And you got to make it really simple.
And I suspect you see a bit of a distinction between your large corporate client and a mid-market client who perhaps has not been at the table to kind of set the new rules, and they're waiting for the Scope 3 disclosure requirements, and then all of a sudden every mid-market company out there is also going to have to disclose what they're doing, right? Yeah. Have they internalized that?
There's been so much conversation around materiality over the past year, and there's a huge distinction. Our upper middle market client is a very different animal than our multinational, or what we call them our major accounts clients, right? Where we're in shared and layered plays as opposed to a first dollar TIV policy, right? It's an entirely different conversation. And the reason being, right, there's a higher level of sophistication. When I'm dealing with a multinational, I'm dealing with a CSO, a CRO, and a CFO. And it's usually where the CSO or CRO is asking me, how do I influence these recommendations to make the CFO put the CapEx dollars in the right place? I believe your data, I believe your story, I agree with you. By the way, we've had loss history. It's harder when there's no loss history, for sure. That's the conversation, convincing the board at that level on a multinational. At the upper middle market, it's a much more simple conversation around wealth preservation for owners and operators. I've learned over the past year where Chubb, we went to the market a year ago and we offered free climate change data to 3,500 CFOs of publicly traded. And we said, we're watching, SEC proposed rule sets 1502. We want you to understand, we would like to share with you what we view as the climate adjusted risk climate change risk to a baseline, and we'll give you 5, 10, 20, 30-year increments, whatever you want. I would say to you, it was shocking to me over the past year to learn how difficult it was to give away free climate change data. So we keep talking about democratization of data and sharing data. I'm going to say it. Data can be a liability, okay? So it's been a heck of a journey, Francis.
Yeah, we're all learning. We're all learning. All right, Rob, buyouts, right? Okay, now that the notes are right. I know you've done a lot of research looking into this, but I think you've also a practitioner as well.
A theoretician,
A
perhaps.
theoretician, okay. I don't think Zach can use words that long, so
Yeah.
it doesn't show up in here. So please tell us about, because obviously the buyouts is one of the most politically charged elements of all this, right? Moving people from property that they have owned maybe for generations. So what is the solution to that?
Yeah, so we know buyouts are among the most effective, if not the most effective way of reducing losses from flood and other hazards, right? You're permanently removing a structure from the floodplain. A structure that's not there is the safest structure from flooding, right? Can't be damaged if it's not there. So that's the idea that does work. The idea that could work is an idea that NRDC has been developing over time to try to make these transactions happen more quickly, more equitably, and to make them more widely available potentially. So before I get into kind of what the idea is that we've been working on, let me just talk a little bit about how conventional buyouts work. So buyouts are typically funded by a government entity. At the federal level, FEMA is, I think, by far the largest financial provider for funding for buyouts. FEMA does not execute the buyouts. They provide the funding. State governments or local governments ultimately are the ones that are purchasing the properties and then hold title to these. At least with FEMA, once a property is purchased, there's a deed restriction placed on it. Nothing insurable can ever be built there again. So you want to put a swing set up? Great. You want to put a restroom up? That might be okay. A house? Definitely not. So you don't have to worry about the property being redeveloped again. So that's great. The problem is a typical FEMA buyout takes literally years to complete. And that puts the person whose home you're trying to buy out in an extremely uncomfortable position. They don't know, for years, they don't know if the buyout is going to happen or is not going to happen. So the delivery of assistance is ultimately very mistimed with the needs of the individuals who reside in that home. So that ends up eroding the number of people who are even interested in this option to begin with. So we lose the opportunity to buy somebody out who really probably wanted to get out. People end up taking a buyout from a real estate speculator who then redevelops the property. This was a huge problem after Hurricane Harvey in Houston. So now we've completely lost the opportunity to even retire that property from the floodplain. And there's just a lot of different things that leave buyouts, the promise of buyouts, relatively unfulfilled, right? So FEMA's funded between 1993, the big 500-year flood on the Mississippi River, and now FEMA's funded approximately 45,000 buyouts. So let's scale that up over the next 90 years when we're going to have 3 to 6 feet of sea level rise. That's going to mean we're going to help about 150,000 people get out of the floodplain. That's a huge gap between the millions of people whose homes are going to go underwater just at high tide. Not thinking about storm surge, not thinking about inland flooding at all. So how are we going to deal with that? You know, we're not going to buy out everybody, okay? But we're going to need to buy out a lot more people, a lot more quickly, and a lot more fairly than we are under the current rubric. And FEMA's not the only only federal agency doing this. So HUD is probably the next biggest player. The data is really hard to find from HUD about exactly how many buyouts they've executed, but quite a few. The Corps, Department of Agriculture, all have pots of money that do smaller numbers of these transactions. But we've looked a lot at what FEMA does. So The idea that NRDC has been working on and developing is there a way to make this process go faster? So we started looking at some severe repetitive loss data that we were lucky enough to get from FEMA. And that started telling us a lot of things about the most flood-prone properties that are part of the National Flood Insurance Program. So these properties flood on average every 2 to 3 years. That's not a very fun place to live in, right? If would you like to live in that house? Show of hands. Of course not. You don't want to live in that house, and neither does the person who lives there. In many instances, and we often spend more in damage claims than that property would cost to acquire in the first place, more than the property's even worth. So in a sense, we've already bought this property, yet it's still there. It's still flooding. People still would like to get out. And so that's a real problem. So what we started thinking about was, how could you pre-approve those people for a buyout? If there's somebody who wants to get out of that home and move to higher ground, how about we front load this process instead of what we typically do, which is the flood happens, flood disaster maybe is declared, the person files their damage claim, they get their damage claim, they repair their home, and then about a year after the flood, local official comes, hey, you ever thought about a buyout? Well, I sure did about a year ago. But as you can see, the paint on my cabinets is dry now. I've just got the drywall back up. I've already gone through one life-changing event. I'm not really looking for another one this year, so I'm done. And the people who do say yes are now locked into a 3 to 4, maybe even 5-year-long wait where they don't know, like, is this ever going to come to fruition? If my furnace fails, do I even put the money into it? Because I'm not getting my house bought out plus the new furnace. So it's really an intractable position to put people in. So if you could pre-approve people for a buyout, then how could you fund this so that they could get their home acquired much more quickly? And the one entity that would have a financial interest in making this happen would be the National Flood Insurance Program. So if there's a property where the person wants to leave and where the local community has a plan in place where they want to start buying up properties in neighborhoods where they know that the flood risk is just going to be too high either today or in the future, and FEMA could look at this and say, well, based on the past damage history and the projected future damage history, we save money buying this property out now and giving the owner what they want versus just playing claim after claim after claim and kind of basically forcing this person to tough it out in this flood-prone home or pass it off to the next unsuspecting landowner. So the idea is basically, without going into all the details, is let's pre-approve people where they want to leave, where the city wants to manage the property long-term, and where it's in the financial interest of the National Flood Insurance Program. Once that person, so we should buy that property out essentially. And that could be done at a couple different triggers, right? So one trigger would be something that already exists in the National Flood Insurance Program, which is the substantial damage threshold. So if a home gets damaged up to 50% of its value, there's already an obligation to elevate that home or take some other mitigation measures. That's a perfect opportunity to say automatic buyout. You've already signed up, you've triggered the buyout, you already get your cost. Or the person may not want to wait for that event to happen. So they may just say, hey, I'm ready right now. Or a small flood happens, and they're like, I don't need to wait for the next big one. So they could say, raise their hand and ask for the buyout. Now there's a lot of details, obviously, that have to be worked out to make this transaction work and deliver the assistance needed. But we're hopefully going to get to that point. And I'll just say in closing, like we've been working with a city, I'll say an unnamed city and an unnamed state in the southeastern U.S. to actually get the concept rounded out, and we're just about at the point where I'll hopefully be knocking on FEMA's door very soon and kind of putting this to the agency a little bit more. But we've had some very productive conversations with the agencies, especially on the hazard mitigation side. Many years ago, Roy, I think you and David Marstad and I talked a little bit about this concept too, so we got some good feedback there that we've listened to. So,
Have you looked at the concept of other buyers of these properties? So I'm assuming these properties are in obviously floodplain areas. Wouldn't they be natural, nature-based solution facility?
absolutely.
Shouldn't somebody come in and actually replace the house with a bunch of mangroves or
Yeah,
seagrass
that'd be
or
great.
whatnot?
Right,
Because that would actually protect the rest of the community.
sure.
Isn't there, I think we got a business idea going down the end of the table, but isn't there a natural cycle there, right? Where it shouldn't just be bought out, so obviously you need the entire neighborhood then to go, right? But that seems like something we should perhaps lean on.
Yeah, I totally agree with that. There's a lot of interest, I think, in the land trust community, natural lands management community about doing this, but they also need funding, right?
Correct.
So, either whether it's a conventional buyout, whether it's a buyout along the lines of what our concept considers, or some other model, ultimately, that purchase of those lands needs to ideally be rolled into a project that further reduces risk for those who remain behind.
Eric, I have a question here that sounds a lot like the question I asked you before. So what do you want to talk about?
We can talk about whatever you guys want. I'll talk about the reality of how we influence policyholders. I think that's ultimately our goal is obviously educating, but encouraging adoption, whether it's emergency. But emergency response plans, that's works. There's business continuity plans. We do a lot of this consulting, a lot of this service today. Let me put that on. So there's the emergency response planning side of it, where we're very actively engaged with partnering with our clients. But before we get to that point, there really is the sharing of the leading edge climate risk data piece of it. And I think the simple reality is most customers, and I've heard this time and time again from a homeowner's perspective, and it absolutely rings true in the commercial book as well, in the middle market book, small commercial book. And surprisingly, within the major accounts, multinationals with formal ESG efforts, where they don't know where to start, Francis. They literally don't know where to start. And so many of my conversations begin with, let me give you data as a starting place. I'll give you free data. I'll give you best-in-class climate change data, not natural hazards, historical probabilistic model data. I'm not talking a bunch of Nat Cat models that you're used to getting on your loss control reports for years. I'm talking about the newest market solutions for crystal balling where it's going, right? Quantifying what hasn't been previously quantified. And when they get that, our customers usually just want to talk about it before they even decide on taking a step further around property resilience. And I will share that some of the industry practices that I thought a year ago would be completely sold on the process of letting data lead their scenario analysis, which is a fancy word for climate change risk assessment, right? Scenario analysis is a very fancy term for climate change risk assessment. When we buy a property today, we're all used to fully expecting a property condition report. Well, the lenders and the banks and the UK market, right, it'll become very, very normal in a very short time frame to fully expect when you take a mortgage out and you take a loan out that the bank will require a property resilience assessment, a PRA, right? And we're practicing that today, delivering it to our customers today. It's much more of an art and a science than a pure science. When you get an engineering inspection report, we've had many, many years to fine-tune those probabilities, to fine-tune those risk management recommendations, to give near-term guidance. But when you're talking about guidance to invest or to direct CapEx investments to a CFO on medium-term or long-term or the life of a loan, a 30-year loan, it's a very different conversation. there's no question our best bet in terms of data, model uncertainty, actionable, meaningful mitigation and adaptation measures, in my mind, are near term. Focus on 5-10 years. Start somewhere, you know. I think
And Eric, what if those measures are not actually, that the individual firm you're talking to is not capable of doing that? What if the measures actually need to be done at a community level? Do you engage them or encourage them or somehow facilitate that dialogue, because it has to happen with the city or the county or the region?
yeah, we're doing it more and more. It's definitely top of mind on our senior leadership's level, is how to take this location level, granular. And this topic came up, I think, on your session, where a gentleman mentioned flood barriers. You know, your city becomes full of single location, large properties. I think of the news, you see them today, surrounded in aqua fences or other types of temporary flood barriers. And how is that being translated to the community level and the community, you know, planning level? I think ultimately, you know, where the insurance marketplace will go and needs to go is getting a clear picture of where these recommendations are or are not being implemented, right? Whether it's a home ignition zone approach on wildfire, or structure ignition zone radius on wildfire, or a flood mitigation engineering measure, we can track as an insurance carrier where these recommendations are getting completed or not. And where we find that they're not getting completed, or we identify these problem areas, right? How do you exert the pressure on the community to take action and to gauge what action they're taking and the effectiveness of that action? I can tell you, Chubb was very active over the 2020 wildfire season, you know, in geographies where we were engaging directly with communities around understanding the effectiveness of their community wildfire prevention plans. You know, not only obviously the hazard identification piece, but the actual mitigation measures they were or were not taking. And we were internally ranking them, all right? We were internally benchmarking them. So we're getting from the location level very quickly in the industry to the county level, and then it becomes highly political. I'm an engineer. I'm not an underwriter. I'm not a cap modeler, and I'm certainly not a politician. But I would say that, you know, it becomes a really interesting conversation when you have aggregated internal data to say, okay, we've looked at every county and we've consulted every fire chief and authority having jurisdiction purely on one secondary peril, wildfire. And we can rank these measures, we can score them, and then it comes down to, well, you know, how do you want to affect that community level change? And it's a dynamic that the insurance industry is absolutely more actively exploring, doing, practicing to get more community level mitigation measures enforced and recognized, updating in terms of emergency response plans, providing best practices around wildfire mitigation plans or flood emergency planning. You know, I think of post-Sandy, you know, everything south of Canal. I worked in the S&P building for many years, the Standard & Poor S&P 55 Water Street, Manhattan, in the financial district. It's the largest office building in Manhattan. It's 3.5 million square feet. Before Sandy, it was literally marketed as the most resilient office building in Manhattan. The largest and most resilient, has like 5 sub-level basements.
On Water Street.
On Water Street.
You're gonna love it.
Right across from Guardian Life. And, you know, you look at how many large real estate buildings 10 years ago sat empty, losing rent for a year. And you basically, you know, the insurance marketplace really quickly realizes that when everyone puts up aqua fences around their singular properties.
What's an aqua fence? Is it like
these are just
a moat?
temporary. temporary flood barrier systems, temporary flood fences. There's many different companies out there today with these solutions that over the past 10 years, you'll see them on the news like Tampa General. You'll see entire hospitals with thousands of linear feet with these temporary systems to keep the water out of the building as best as they can. But when you have these individual measures, Francis, right, they just displace water, right? From an engineering perspective, the water's going to go somewhere else. So it does become a much larger conversation around who's going to fund and address the much broader mitigation need, which in Manhattan, over the past couple of years, they've really just finished a lot of the permanent flood control measures that started right after Sandy. So it takes a lot of time and a lot of money.
Yeah, I guess we can expect to see like mangroves down there at some point, right, in Manhattan.
I won't be surprised.
All right. We're running a little bit out of time, and I've got some questions here, but I think I want to go to kind of the bigger question about if you are able to drive fundamental change in the system. And I think everything we've talked about here is incredibly positive and constructive, but it's incremental. It hasn't fundamentally changed an environment. Maybe the North Carolina Fair Plan would be a bit more transformational, but if you could, live the spirit of SBP and their discontent, constructive discontent. By the way, at the board level, it's not always constructive, but it's often discontent for purposes of wanting to do more and more and more, right? If you could do that, what would it be? Rob, maybe we start with you. What would that, true change look like?
Yeah, I have a couple answers to that. I think one is just looking at issues like sea level rise. We're going to have to quickly get comfortable with the idea that everybody can't live in the same place that they live today. And a sizable proportion of those people are going to need assistance to get somewhere safer. And that's something that every coastal community, every inland community that's deep in the floodplain, the sooner they get comfortable with that idea and start working on it in conjunction with their residents, the better off that community is going to be. And I think the second one I would mention is, I think we in everything we're doing in disaster preparedness, disaster response, disaster recovery, we've got to start putting people in front of property. If you go through state hazard mitigation plans, they are all based on property metrics, like damage metrics, insurance metrics. Everything's driven by property damage, and very little of our planning and our recovery efforts are focused on what do the people who live in or depend on those structures, what do they need? And that's very emblematic, I think, of the approach we do on buyouts, right? Because we approach buyouts as the challenge is, how do we get that property, that structure out of the floodplain so we don't have to repair it? Therefore, there's not that much urgency to get it done quickly. Whereas from the person who lives there standpoint, they need that to be part of their disaster recovery. They don't want to pursue this as they're not donating 5 years to reduce the damage statistics in the county. So I'd say people versus property.
People versus property and deeper appreciation, understanding of the challenge among the people. Don, I think you've actually probably done this before, meaning how could we transform the North Carolina market, and you guys went ahead and did it, but what else would you do? What else needs to be done?
Well, I guess to confess, sometimes I think what we did is sort of a waste of time. Honestly, making sure that these houses don't get flooded from the top down when they're going to be floating away at the Outer Banks makes me worry about rearranging deck chairs. I can't do anything about that except to come back to flood in just a moment. But honestly, if it wasn't just for our political and probably corporate charter, I think it's a crying shame that at the time we put on these new roofs, we are not actively putting solar on and light shaded shingles on every single roof we put on. The time to put on a solar system is when you put on a new roof. It's a big headache to replace one later that'll stop people from doing it. So I'm not speaking as a member of the board, but as an academic, certainly, I think it's a real shame how insular we have to be as a board when there's just a huge opportunity, just a small one, but a big opportunity I know is right there that is not going addressed. Bigger, it's all about flood. At some point, whatever we do on wind is just a rehearsal for the real game, which is all flood. If I had to just be realistic long-term, and you deal with the institutions we have, somebody said they were real fans of the CRS, the attempt to link public flood insurance, whatever its faults and however it's priced, with the idea that there are real land use changes made by communities that want to participate in the program. That has been attenuated almost to non-existence. The actual amount of land use abuses that are taking place in these communities that are supposed to have zoned out development from floodplains is astronomical, and the federal government has done nothing about it. And even if you were going to pay your way out of it with the CRS, that could be done far more systematically for the property we do have now, like in the near term, 10, 20, 30 years. As a practical matter, and I wanted to move to flood, I would be working there.
All right, Eric, you have a magic wand in your hand and you can change something fundamentally. What is it?
Well, so I heard several times over the past 2 days, how horrible humans are planning for risks of which they've not experienced directly or even indirectly. And it's very true. I think climate change risk is the modeling industry behind it is very nascent. It's very young and it's very uncertain. I think accessibility to visualized climate change data is a huge issue. It needs to be accessible. You need to see your risk. As a customer, as a homeowner, as a guy who has a beach house, and I'm not going to apologize for it. When I show you your risk in a bunch of Excel spreadsheets versus a visualized tool that's easy for you to understand, and I give you levels of certainty and uncertainty, and I give you econometrics so you can clearly understand the risks in a forward, future-facing world, even near term, right? You are much more likely to act. You are much more likely to plan, and you're much more likely to consider practical, actionable mitigation measures. I'll go one step further. So accessibility to visualized, easy to understand data of secondary perils as broad as possible, not just flood and wildfire. Flood is some of the best modeling out there in this industry. Wildfire is still very, very new. But you want as broad spectrum as possible, and you want to understand IPCC overlay emission scenarios, RCPs, SSPs. You want to look at what that looks like. But how do we get that kind of data appreciated at the building code board and technical committee level? I work on new buildings, $500 million high-rises routinely, where their basis of design is based on rainfall intensity models and return periods and flood elevations from many, many years ago. It's inadequate, and that's brand new construction. And my likelihood of getting success for existing infrastructure retrofits around mitigation, hardening, adaptation is that much tougher. Think about raising mechanicals up to upper stories in lower Manhattan, electrical rooms, fire pumps, all that good stuff, right? Let's get it out of these lower levels, let's bring it up. Those are hundreds of millions of dollars of investment on a retrofit. Design changes on the building code side, they're much cheaper. So get the insurance carrier engaged as early as possible on even the selection of the land, the development. We've worked with developers. We work with our clients routinely on choosing their buildings. Years ago, it would be choosing buildings for adequate fire protection. right? You think of insurance, primary perils, and a lot of the conversation was fire protection and fire protection adequacy. Well, today, that conversation is just as much adequacy of the land for the new building in terms of secondary perils, natural hazards, climate change. You got to partner with your insurance carrier. You absolutely have to partner with your risk engineering and your loss control professionals, and you got to make them show you the risk. That's what you got to do.
So Eric, if I had a magic wand, I would point it in that direction over there where my friend Roy Wright is sitting. And I would have under him or near him or around him somehow a program called Certified Communities or Fortified Communities. Because what you're talking about is a community that is internalized exactly how to lever the systems, to work to pull this string here because we need to do something over there. Understanding it all comes together and it has to happen at the community level. I think the insurance industry needs to formally and institutionally inject itself, as we never have before, into that system. I don't know how, but I know that Roy knows how, just because I know Roy knows just about everything here. But it is that concept of recognizing excellence as opposed to criticizing incompetence or worse. And I think we have the expertise to do that, and I think we have the influence to do it, and we've got the people to do it. I'm not pointing to you, Roy, because you're derelict in your duty by any stretch. That is not the point to point you out, but it is the point that to take what they've done, what IBHS has done at the individual construct level, and to do it at the community level, to me, would be an incredible public service. And we would achieve what I think all these three gentlemen said had to be achieved. Are there questions from the audience before we hand this back to Carolyn? I assume you. But are there questions from the audience? You want to defend yourself, Roy? Or you just tell me to shut up, I'll shut up. Oh. Over here.
Yeah, I mean, one of the features of the National Flood Insurance Program that private insurers don't have to deal with is NFIP doesn't have the ability to drop coverage on anybody. So would that motivate more people to leave? Probably. However, the lack of coverage that we already see now doesn't seem to be driving people to leave these places. And it's not even slowing them down from moving into these places right now. I think it might just amp up the financial pressure on the people who can least afford to weather it. So I think I can understand why the NFIP why FEMA wants the NFIP to perhaps be able to drop coverage, and I think there's very good reasons for that. But I don't think that should not be the way that we're going to force people to kind of reckon with this problem of relocation. Maybe we'll be at that point at some point. Maybe 50 years from now, the preferred tool is going to be eminent domain, and we just buy everybody out and we go that route. We're not there right now. I think at this stage, what we do know about people who want to get out of flood-prone areas is that there are a lot more of them than our programs can currently serve. So let's focus on how can we deliver that assistance in the most humane and equitable way today, and see how far we can get before we're forced to make those more difficult choices.
Mike?
Oh, well, first of all, Mike, it's good to see you again. We saw each other in Sacramento maybe about 5 or 6 weeks ago. No, for the grant program, it's first come, first serve until we run out of money, and we've never run out of money. In fact, our real question is what do we do to get more people to apply? And that's why we just raised the money, so raise the amount. I will say that Alabama's amount, which is $10,000, which is going to be Louisiana's amount in 2 weeks, $10,000. I think when Alabama last had their offering, the phrase was, it sold out faster than a Taylor Swift concert.
Whoa.
2 hours, they gave away whatever it was, 10 or $15 million. They opened it at midnight, and it was fully subscribed at 2 a.m. And that's what Jim Donnellan at Louisiana said he wants to do in the rollout in Louisiana in a couple of weeks. Taylor Swift. So
Operation Taylor Swift.
I think we have time for one last question. Over here?
All right, well, I would agree with you that it should be, all right, but it costs a lot of money, right? If you were to take a new build in the Mid-Atlantic zone and you project the likelihood of a Cat 4 hitting it in 50 years, it's probably the same likelihood of a Cat 4 hitting Florida today. So if we're going to design buildings for the life expectancy of the building, there's a significant increase in cost to do that, right? Whether you're talking glazing and impact resistance to roof design. Now, as a structural engineer background too, there's a clear emerging hazard to the concept of underground climate change and stress on foundations and how that's going to impact infrastructure, potential collapse exposure, all right? These are fantastic questions. Codes, whether they're fire protection or building, are minimums, bare minimums. They are generally oriented around life safety and not property protection. The rallying cry is the insurer's own greed and interest, of course. We want our insureds, like any other business, to be insurable for a long time, all right? So I think the incentive, and I think I think every insurance company, you mentioned the TCFD reports of all the carriers. I mean, I hope you read these TCFD reports because they give you a good lens as to senior leadership's commitment to this broader social issue around the reality of how climate change